All right, hey, hello everyone. I hope you all are doing well. What I wanted to do is make a pretty simple video and to kind of hone in to people who are in business. So this first video will be about someone who is a sole proprietor and who has a profit and loss form in their tax returns. So this is guided towards someone who could be possibly looking for a home and or looking to possibly refinance, depending on what type of situation that you're in, just for your traditional style loans, which is could be conventional, FHA, VA, USDA. So these are some of the items for a person who is self-employed or a sole proprietor who has a Schedule C in their tax returns. So what we will do is look at your past 2 years. And what I have done here is kind of set up a couple scenarios to give you a good idea of how those numbers are crunched down. So even if you're working with a CPA or accountant, they're typically looking at these numbers too, and they can give you an average balance of what you are making per year as well. So as you see here, we are normally looking at your net profit and or loss, which is line 31. And so this is what, in the scenario, we have $100,000, but in 2020, it was only 58,000. So as you see with all these different line items, what we do is kind of plug these in. If you guys have any requests on how to receive like the manual form that Fannie Mae offers for this, I can send you out one as well. But one of the key factors that I want to make note of is that a lot of people write off meals and entertainment. Now, when you're filing taxes, that can be a credit for you. But when you're looking for a home, that is a debit. And what I mean by that, that is deducted from you. So let's say I take off this $2,300. You see, the subtotal income instantly went up. So, I'm giving you all these tips so you can keep in mind as to what is counting for you and what counting against you, and what some things you may want to hold off on when you're filing your taxes. So as well here, when you're driving, you're racking up some miles, those are also a credit for you. So that can be added back to you as income. So some of these situations, for most sole proprietors, they're not necessarily that normal, but one of the key factors that I want you to focus on here. So back in 2019, when life was pretty normal, pre-COVID, the typical, you know, sole proprietor, let's just say they made $100,000. But let's say, COVID hit, but their income drastically decreased. So in a situation like this, from one year to another, where there's a decrease and not an increase, if it's more than a 20% difference, then that particular borrower may have to be manually underwritten. Okay. And so that means that an underwriter is manually going through all of your documents versus us putting you through a system where it's capturing all of this information and giving us an instant reply and an instant approval. This, in instances like this, it has to be manually underwritten. So keep that in mind. So also, as you see here, person has driven maybe 10,480 miles, and at 27 cents, that is credited back to you. Okay, one of the number one things or issues that I know a lot of people who are either 1099 or just self-employed in general. Let's just say 2019, this is what you made, but on your tax return, you say, that's what you made. But you have enough, you have a lot of cash, you have all these things in reserve. We have no other choice but to go after what you have reported. So if you're not reporting your actual income, you're not helping yourself out if you're actually looking to go into a conventional FHA type of loan. So those are the things that you need to keep in mind, that you must report your actual income, because when you don't, and you're decreasing it, just, for some people may do it for all different types of reasons, but always keep in mind, This is what we must go off of. We can't look at anything else. There are other type of loan programs out there where sometimes it's very hard for someone to qualify based on their tax returns. And did I remind you, you won't have the same criteria and you won't have the same down payment as your conventional or your FHA, which is around 3 to 3.5%. You're going to probably start getting to the area where you're putting 10%, 20% down. So those are what are called typically non-QM loans, non-qualifying mortgage loans, because they don't fall into the same criteria as qualifying mortgages such as conventional FHA, VA, USDA. All right, but either way, if you have any questions, or even if you want to receive one of these forms, I can send you the hard copy form and you can kind of see where you line yourself up with, or even if you want to just schedule a time with me to go over some of your documents and to see what we can get you pre-qualified for or pre-approved for, I would say, just let me know. Until next time, any other questions you have, please feel free to contact me. Thank you.